The rally on Wall Street is hitting a critical test, and the next few days could determine whether it holds. Major indexes have clawed back significant ground in recent weeks, recovering losses that had built up earlier in the year. It has been a notable turnaround, but two forces are now bearing down on that momentum: the monthly jobs report and the Federal Reserve's shifting signals on interest rates. Start with the jobs report. It is one of the most closely watched pieces of economic data on the calendar, released monthly and capable of moving markets sharply in either direction. Investors are watching it closely right now because of what it could mean for Fed policy. Here is the tension. The US labor market has been unusually strong. Low unemployment, steady hiring. By most measures, the jobs picture has held up well. But that strength creates a problem for anyone hoping the Fed will cut rates soon. A hot jobs report signals a healthy economy, which gives the Fed less reason to ease up. That means higher borrowing costs stick around longer, and that tends to weigh on stocks. Higher rates raise costs for businesses and pull down the valuations investors are willing to pay for equities. Flip it around. A weaker jobs report might raise hopes for earlier rate cuts. But it also raises a different concern, that the economy is slowing. That is its own kind of bad news. Neither outcome is straightforward right now. Investors are caught between two uncomfortable scenarios, and there is no clean read on which one they would prefer. Then there is the Fed itself. Policymakers have grown noticeably more cautious over recent months. Inflation is still running above the Fed's 2% target, and officials have been clear. They want to see sustained progress before they start cutting. Any change in that tone, whether it leans more hawkish, meaning tighter for longer, or more dovish, meaning relief is coming sooner, can move markets fast. What makes the current moment particularly tricky is the combination of a live data release and an evolving policy outlook arriving at the same time. Markets can absorb a good number or a bad number. What they handle poorly is genuine uncertainty. And right now, uncertainty is the dominant condition. The jobs figures and whatever Fed commentary follows will likely set the tone for markets heading into the summer months. The practical takeaway here: in environments like this, where a single data print can reprice rate expectations overnight, it pays to watch not just the headline job number, but also the wage growth figures, because persistent wage pressure is exactly the kind of evidence that keeps the Fed on hold. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.